All right, welcome to today's Explainer. We are going to just dive right in today because we're about to completely dismantle everything you probably thought you knew about what a successful investment strategy is actually supposed to feel like. I want to immediately challenge a core belief that, let's be honest, pretty much all of us hold. And that's the idea that if you're making the right financial decisions, you should feel, well, good, secure, and entirely comfortable. But what if I told you that a genuinely successful portfolio should literally never feel completely comfortable? Okay, let's get into this because the first 6 months of 2026 have just given us an absolute masterclass in the deeply uncomfortable psychology of the conscious investor. Listen to this quote. If you like your portfolio, you're doing something wrong. I want you to really stop and evaluate your own recent financial decisions for a second. Think about the last time you opened up your brokerage account, looked at your portfolio, and felt this massive rush of euphoria because, hey, everything was in the green. It feels amazing, right? But here's the harsh reality. Euphoria is actually a massive red flag. When investing becomes thrilling and entirely satisfying, just a joyride, that is precisely when the absolute biggest unseen risks are hiding just beneath the surface. We really need to cross a massive psychological divide here. You see, our common sense tells us to chase that euphoria, to seek comfort, and to jump on trendy bets. But market reality? It demands that we essentially install a brand new algorithm in our brains. The whole concept of unpleasantness or just profound discomfort, it's not some temporary glitch in your investing journey. It's a structural feature. It is literally an investor's greatest asset. Basically, as long as your portfolio makes you slightly uncomfortable, you are probably right on track.
Act 1. The semester's masterclass and emerging markets. Let's look at the actual empirical evidence from the first half of 2026.
Plus 32%. That was the massive year-to-date surge in emerging markets during the first semester. Now, just to put that into perspective for a second, global developed markets grew by about 15% in that same time. If you had just listened to the comfortable, mainstream, everyday narratives, you would have completely missed out on this. The market actively rewards investors who are willing to make those counterintuitive and, quite frankly, really uncomfortable bets. So the really crucial point here is understanding exactly why this happened. And the structural reasons are just fascinating. You've got this massive tech and AI leadership from companies over in South Korea and Taiwan, vastly improved corporate governance, and super low public debt that's allowing for serious fiscal expansion. But here's the real catch. Extreme volatility. I mean, the Korean market alone hit a staggering 47% volatility rate. To actually capture that 32% return we just talked about, investors had to stomach utterly terrifying daily drops. We're talking sometimes 10% in a single day. That is the physical price of outperformance. Highly unpleasant? Absolutely. But also highly profitable. And this brings us to what is essentially a fundamental law of finance. The market just simply knows more than the best individual expert on earth. During the geopolitical catalysts of the semester, like the conflict with Iran, these apocalyptic consensus narratives were literally everywhere. Experts were out there predicting oil would skyrocket to $200 a barrel. Equities were going to crash, the whole shebang. But what happened? Instead, the market rallied, and oil actually dropped by nearly 30%. Giving credence to the market over those terrifying common-sense news headlines, yeah, it's uncomfortable, but it's almost always the right strategy. Act 2. The unexpected triumph of the dollar. If you want another absolutely perfect example of how consensus narratives can be dead wrong, we have got to talk about the US dollar. For over a year, the super comfortable narrative was that the dollar was in this inexorable, unstoppable decline. But why did the US dollar actually completely defy expectations and become the true safe haven asset of the semester? Well, first off, the global energy shock didn't weaken it at all. It actually acted as a catalyst, reinforcing the dollar as the ultimate currency of last resort. Second, rising bond yields, coupled with a hawkish Federal Reserve that completely held off on cutting rates, massively boosted its attractiveness. The exact thing everyone thought was a lost cause just ended up becoming the anchor. And just look at the result. European investors actually gained this totally unexpected 5% yield boost simply from holding assets in dollars. When gold and bonds completely failed to give any protection during market stress, the dollar stepped right up. This proves without a doubt that true diversification often comes from the exact place we didn't expect. And honestly, usually from the asset we were the most frustrated with holding just a year prior. Act 3. The price of diversification. We've talked about the winners, but now we really need to look at the assets that caused investors the absolute most pain, frustration, and discomfort over the last 6 months. Take gold, for example. It had this massive run-up to $5,600 an ounce, heavily driven by retail momentum.
It became this really trendy, fun asset to own. But what actually happened when geopolitical tension peaked? Instead of acting as a safe haven like you'd logically expect, investors liquidated it for cash. Then, as bond yields rose, gold just collapsed right back down to $4,000 an ounce. The lesson here is absolutely critical. Gold only acts as a reliable diversifier until it becomes a trendy, high-beta asset. Once everyone is having fun buying it, it completely loses its protective power.
Now, let's talk about the absolute most frustrating asset to hold right now: bonds. If you look at a broad European bond ETF right now, it is sitting at the exact same price it was 11 years ago. Literally zero return. It feels entirely senseless to hold it, right? But there is this really counterintuitive mechanical relationship at play here. Because bonds pay fixed coupons, as their current prices fall, their expected future yields mechanically rise. The very fact that bonds have been so terrible lately is exactly what makes their future expected returns so much more competitive today.
And then, of course, we have commodities, which rose 20% this semester. Their behavior honestly explains perfectly why they drive investors completely crazy. Think of equities as symmetric. They spend most of their time growing, with rare crashes. Commodities, though, they are asymmetric. They spend incredibly long, painful periods losing value, followed by these sudden, highly concentrated spikes in growth. To get that 20% spike, you had to just sit there and suffer through years of negative returns while all your equities were booming. So, let's summarize the harsh truth about diversification with these two major sacrifices. First, you just have to accept leaving potential returns on the table. It's going to happen. Second, you have to accept that your diversifier will often fail right when you think you need it most. Listen, if everything in your portfolio is up and making you feel like a total genius at the exact same time, you aren't actually diversified. You're just highly concentrated in a single risk. Act 4, unpleasantness as a compass. This leads us to solidifying exactly why these uncomfortable feelings aren't just some annoying side effect. They're actually the ultimate indicator of a highly effective portfolio.
Why is discomfort essential? I really want you to ask yourself, did you only buy gold when it was skyrocketing and all your friends were talking about it at dinner? Or did you actually have the mechanical discipline to keep buying it while it was painfully dropping back down to $4,000? Our instinct always tells us to buy what's going up and sell what's going down. But discomfort forces us to do the exact opposite, which is exactly where the actual premium of investing is earned. I want you to really internalize these concepts for a second. Boredom, regret, frustration, discomfort. These are not signs that you are failing as an investor. These are the exact emotions of a mature, conscious investor. These negative feelings are literally the toll you have to pay to the market in exchange for those long-term returns. If your portfolio gives you total satisfaction all the time, you are totally blind to your exposures. The market always demands its pound of flesh. So I'll leave you with this final, somewhat provocative thought. Look at your investments today and ask yourself honestly, is your portfolio making you suffer enough to guarantee your success? Because if you aren't feeling at least a little bit of regret or frustration about some part of your strategy right now, well, it might be time to take a much closer look. Thank you so much for joining me on this explainer. Keep embracing the discomfort, and I'll see you next time.